And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, we're working on your financial freedom. And we're going to do so today by asking a question. I'm going to ask you a question, and I want you to shout back at the radio or shout back at your phone or however you're getting this content, your answer. Okay, now, if you're in a crowded restaurant, maybe shouting back is not the right way to do this. Maybe just do it in your mind. You know, you don't want to embarrass yourself in front of a crowd of people. But I want you to give me some feedback. And here's the question. Do you think you can buy real estate for 6 cents on the dollar? Yeah, 6 cents on the dollar. And you're a lot of you are just yelling at the radio right now, yelling at your phone or thinking at your phone, and you're saying, "Yeah, Al, I don't think you can buy real estate for 6 cents on the dollar." And I'm here to argue with you. I am. I'm going to argue with you. I'm going to argue that you can buy real estate for 6 cents on the dollar. You want to know how? Well, here's how. The first thing you need to do is join Lifestyles Unlimited like I did in 2017, because they're going to teach you all of this stuff. And once you are armed with the information, you can go forward and you can start buying your own real estate for maybe 6 cents on the dollar. But let me explain to you how you can actually buy real estate for 6 cents on the dollar. Shall I? Okay, let's do this. Moon, who's one of the Lifestyles Realty members, he operates out of the greater Houston market. As a matter of fact, he's like a top producer in the Houston Association of Realtors. He gets plaques every year, and he's a part of the Lifestyles Unlimited team, and we love him because he goes out and he finds great properties in the Houston area for Lifestyles Unlimited members to purchase. And it's a great relationship to have. When you've got a real estate team in your area that's looking for assets that meet your expectations, you can't help but be successful. I'm serious. You can't help but be successful. So let's get back to this 6 cents on the dollar thing. How do you do that? How do you buy a property for 6 cents on the dollar? Well, it's easy. It really is easy. And here's how you do it. You find a property like this property that Moon found, which is a 3-bedroom, 1-bath, no-car garage, built in 1982, 1,364 square feet. It's a little tired. It's a little worn out. And the property can be purchased for a price of $108,000. Now, you're not going to pay cash $108,000. What you're going to do is you're going to pay a certain percentage of your all-in costs when you acquire, rehab, and put back into service this property. And the way you're going to do that is you're going to use a hard money loan. Now, I know some of you are afraid of loans. Some of you think leveraging properties is not the smart way to do it. And I'm here to tell you it's a very smart way to do it. When you control the resources and you utilize them correctly, they give you a lot of great benefits. They really do. And a hard money loan is a great way to leverage your property. Now, let me explain to you a little bit about that hard money loan. I know all you Lifestyles Unlimited members are like, yawn. I know all this stuff, Al. Get to the meat and potatoes. But you guys, come on. We got to help all the people that don't know all this stuff yet. And that's part of the reason we're doing this is we're helping all those people, right? And so the Lifestyles Unlimited members go, yeah, you're right. That's the way we roll at Lifestyles Unlimited. We help each other out. So I'm going to help you out by explaining to you how this is going to work. So this particular property that's in the Houston marketplace can be bought for $108,000. That's your acquisition price. And you're going to put about $37,500 in repairs and closing costs and holding costs into the deal. So you're going to take that $108,000 and you're going to add like $37,500 to it. And that's going to give you an all-in number. Yeah, it's about $145,000, roughly. So what does that mean? That means that's your all-in cost for everything, to do everything, to buy the property, to renovate it, to pay for the closing costs, to pay for the holding costs, your expenses of ownership while you're doing the rehab and putting it back into service. So how are you going to buy it for 6 cents on the dollar? Here's how. The property is worth $181,000 in the neighborhood that it's in when it's all fixed up. Now, this property is not all fixed up. This property's got issues. It's got about $27,500 worth of issues and about $10,000 worth of closing and holding costs that need to be absorbed. So what do? How do you command this $191,000 price if the property is only worth $108,000? Easy. You know what the values are in the neighborhood. You know that all fixed up, this thing can trade for $191,000. Your hard money lender is willing to loan you 75% of that after repair price opinion. In other words, that all fixed up value, 75%. And you can use that to acquire the property and pay for some, if not all, of the repair costs, the closing costs, and the holding costs. Now, when we sat down and we penciled this property out, what we determined, it's going to take about $11,000 of your own cash to do the deal. You heard me correctly, about $11,000 of your own cash to do the deal. $11,000 in relation to $191,000 works out to be just under 6 cents per dollar that you're investing. You're physically putting $11,000 into this deal. The hard money's covering everything else. This is a good scenario. In the next segment, I'll continue the thought. Stick around. Welcome back to the show. So we're going to continue that thought. You want to continue it? Because you're interested now, right? You're interested in the fact that you can spend $11,000 and buy a property that has the potential to be worth $191,000. Now, we say the potential to be worth because what we're looking at are what comparable assets in the area have sold for, and that's kind of where we're getting our pricing opinion from. We're looking at the quality of the asset, and we're looking for the nicer assets in the neighborhood. Those are the assets that we're going to compare to. So $191,000 seems to be the sweet spot. That seems to be what this property is really worth. But it's not worth it today because I told you that, right? I told you it's available for $108,000 because it's got problems. It has things that need to be corrected. And those corrections are going to cost about $27,500 to make. Now, you take that $27,500, you add another $10,000 for closing and holding costs. That puts you at about $37,500, right? You can buy it for $108,000. So you take that $108,000, you add that $37,500 to it, and you're at like what? $100 and some odd $1,000, right? $145,000. So the difference between the after repair value and your all-in price works out to be about $45,500 in additional equity that you're going to capture in this deal. And you don't even know what that means, do you? Okay, let me explain it to you. So additional equity is the equity, and it's an unrealized capital gain because it's equity that's built into the property based on the after repair value. It's money that you effectively make in the deal when you buy it, because you're putting $11,000 of your own money into the deal. You're capturing an additional $45,500 in equity. That gives you a total of $55,500 in total equity. It's a 414% return on capital gain. And keep in mind, your all-in cost is not going to be $191,000. It's going to be $45,500 less. That's pretty cool, huh? That's really cool. Now, the $11,000 that you're putting into the deal, you're putting that money in because the hard money loan couldn't cover 100% of the acquisition and repair and closing costs. But effectively, what you're covering down on are the closing and holding costs. That hard money loan covered just about 100% of the repair estimate. Now, have I gotten you confused yet? Because I know some of you are confused. Some of you are like, dude, I don't even know what you're talking about. Restate what you're telling me. Okay. You're going to buy let me say it again. You're going to buy a property that's worth $191,000, all fixed up. You're not going to pay $191,000 for it. You're going to pay $108,000 for it. Your cash contribution to do the deal is $11,000. You're going to use a hard money loan to cover the acquisition and closing costs. And then as you renovate the property, you breathe new life back into it. You make it worth that $191,000 because now it has all the features, it has all the repairs, it has all the things that it needs to be worth $191,000. You're going to refinance at a 75% loan to value at $191,000. And you're going to own that property for as long as you choose to own it. And you're going to make money 5 different ways. It's pretty cool, right? 5 different ways, not just one way like you're used to in the stock market. 5 different ways. Now, we've talked about the equity capture. The fact that you're putting $11,000 into the deal, but you're capturing an additional $45,500 of equity, giving you a total equity of about $55,500. That alone is a 414% return on capital gain. That is very significant. Another thing that you're going to get from this property, based on what it is worth in the rental market compared to what your expenses will be as you operate the property, and if you've done everything correctly, you've done everything the Lifestyles Unlimited way, you have repaired everything that can go wrong in the next 5 years, or you've replaced it. So the odds of you making repairs on the property are pretty slim because you've looked at every system in the property and you've determined a useful life for that system. And if that system doesn't give you at least 5 years potential of useful life, you make repairs so that it does, or you replace it so that it does. By doing so, you don't get hit with a bunch of phone calls from the person living there saying, hey, this broke and hey, that broke. Because the reality of it is, if it broke, they probably broke it. And if that's the case, and it usually is, it's on them to fix it. I mean, you could fix it for them and bill them for it. I mean, that's one way to do it. That's the way I'd prefer to do it. But at the end of the day, you shouldn't have any repair costs because you've gone through everything and you understand exactly what the serviceability is on every system in that house. Pretty cool, right? So you take the rental income, you subtract your operating expenses, which should be your mortgage, your taxes, and your insurance, and what is left over is your monthly cash flow. Now, we're estimating the monthly cash flow to be about $207 per month. So when you annualize that, you get just shy of $2,500 per year in additional income coming into your house. Now, I don't think any of us can retire off of $2,500 per year of income, but it's a start. So you decide you're going to own and operate this property, and you're going to hold it for how many years? How long do you want to hold the property? You want to hold it for at least a year and a day. And the reason you want to do that has to do with something called capital gains taxes. Capital gains are broken into two different forms. One is called short-term capital gains, which is for any asset that you hold for a year or less, and long-term capital gains, which is for any asset that you hold for a year and 1 day or longer. The different taxation rates between the short-term and the long-term are significant. Long-term capital gains rates are much more favorable to you and I, the real estate investor, than short-term capital gains rates. So we want to hold this property for at least a year and a day. But how long should we hold it? When we come back in the next segment, we're going to talk about that. Stick around. Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. My name again is Al Gordon, and as always, we're working on your financial freedom. And we're doing so by breaking down a potential deal so that you can learn. I want to help educate you on how this works. Now, a lot of this information that I'm sharing with you, I realize I'm hitting you with a fire hose, and it probably feels like a fire hose. When you become a member of Lifestyles Unlimited, this becomes a lot easier because we're going to put you through training that's going to break all this down more succinctly than I can do in an hour. And you're going to be allowed to ask questions so that you get the answers you're looking for. But here, let me sweeten the pot for you. Let's say you have a question about anything that I say on this radio show. How do you get an answer? Well, there's two ways you can get an answer. The first way is you could send me an email at askal@luinc.com. That's askal@luinc.com. The Ask Al is ASK, Ask Al, my first name, AL, at LU Inc. Lifestyles Unlimited, LU Inc. LU Inc. Does that make sense? LU Inc. Yeah, I probably already got you confused, right? All right, that's one way to get a hold of me. Another way won't get you directly to me, but it will get you to one of my teammates that's available to answer your questions. And this teammate is also a Lifestyles Unlimited real estate investor. And they're doing exactly what I'm doing. They're doing what you should be doing. They have real estate investing experience. They can talk to you about this stuff. I mean, if you called them up and you said, hey, you know, Al did this radio show and he talked about all this equity capture, and I just don't get it. Can you explain that to me? You know what they're going to do? They're going to sit back and explain it to you. And you can ask them questions. And if you say, well, I don't quite get that, then they'll try and explain it in a different way so that you can get it. Because at the end of the day, we want you to understand this information. So how do you talk to one of my teammates? Real simple. You pick up the phone, you know, that thing you carry around in your pocket that serves as a computer. It also has a phone feature, right? I'm not talking about your iPad. I'm talking about your iPhone, right? Call 866-945-6565. Let me give you that number again, 866-945-6565. And for those of you that just found your pen and finally found something to write on, 866-945-6565. And here's the thing, you can have as long of a conversation as you want with these guys because they're really about helping you out. They're really about helping you understand all of this content that we put out on our radio shows, on our podcasts, because this is important information. And when I tell you you can buy an asset for 6 cents on the dollar, I'm not lying to you. I'm effectively breaking it down for you. So let's get back into this deal. We were talking a little bit about holding times. We've determined that we need to hold it for a year and a day. And the reason we want to do that, it has to do with the taxation. Short-term capital gains rates are based off of whatever your ordinary income tax rates are, which are usually much higher than what capital gains tax rates are. And that's why you want to hold it for a year and a day. So let's say you do that. Let's say you bought the property, you repaired it, you put it into service, you've got somebody living in the property, they signed a 1-year lease, about 9-10 months go by, and now you're considering selling. Maybe you're going to sell to another investor who's looking for a place that's all fixed up with a resident in place, because they exist out there. You decide to sell. So how do you figure out how much money you're going to make? Well, there's remember, 5 different ways we make money in real estate. You take a look at all the cash flow that you've made. In the first year, you should make about $2,500 in cash flow, right? You take a look at the equity that you captured. It's a one-time deal. But we captured $45,500 in equity, right? You're going to have something called principal paydown, which means every month you make a mortgage payment. A portion of that payment goes to reduce the amount of money that you owe on the asset, which increases your equity. You're going to get something called natural appreciation. Natural appreciation is just that. It's the fact that real estate tends to go up in value over time. I like to estimate about 3.5% per year because historically that's about what real estate does. It does better in some years, not so good in other years, but mostly does about 3.5% per year. So that's additional equity that you get in the asset. And then you get some additional tax advantages. The IRS tells you to take a depreciation write-off. It's a paper loss. You don't actually lose anything, but what you're calculating is what the effective wear-out value of the building is as it goes over time. So you're going to get a depreciation write-off amount, and you're going to use that to offset the taxes that would be payable on the income. And if you've done everything right, the depreciation write-off offsets the tax liability. And in this particular case, there's actually an additional $3,000 of tax liability that you could offset based off what the IRS allows you to do. Yeah, because I'm calculating you're going to have about $5,500 in a depreciation write-off that's going to cover the $2,500 of cash flow that you're going to make. So there's about $3,000 of remaining depreciation that you can use per IRS code against other taxable income. Yeah, that's the way it works. So you're making money 5 different ways. I mean, that's pretty cool, right? I mean, you're not making money 5 different ways doing what you're doing now. But when you get involved with real estate, you will make money 5 different ways. Now you're going to be shocked, because what I have here is I've got a spreadsheet where I've taken into account everything. I've taken it all into account. I've taken into account the fact that you're making cash flow. I've taken into account that you captured equity. I've taken into account that you get an appreciation value based off a natural appreciation every year. I've taken into account that you get additional equity because you're paying down your mortgage every month. I've taken into account that your cash flow is protected by the depreciation. And what I've determined is that if you sold the property at the end of year 1, let's say year 1, plus a day, because we want to make sure that we're getting the benefits of the long-term capital gains rates, right? If you sold the property at the end of year one, you would have turned $11,000 into almost $43,000. Let me say that again. You would have turned $11,000 into almost $43,000. Your net total return, which is the amount of money you make minus the $11,000 you put into the deal, is $31,700. That is a 288% return on investment. Just by owning a property for 1 year, your total rate of return, 288%. Now, where else can you get returns like that? I don't know. I'll be honest with you, I don't know. But I do know you can get it in real estate. And this happens to be a deal that can produce that. In the next segment, we'll talk about if you held it longer. Stick around. Welcome back to the show. So as promised, I'm going to talk to you about what this asset does if you held it for 2 years, if you held it for 3 years, if you held it for 4 years, even if you held it for 5 years. Now, how long you hold your asset is a very personal decision. And it's something you need to figure out as part of your strategy for how long you want to hold the asset. Yeah, there's a strategy. So now check it out. I told you that if you held for a year and a day, that you would have turned $11,000 into almost $43,000, effectively giving you a total return of $31,700 over and above the $11,000 you put into the deal. And you did that in a year. If you held the property into year two, my numbers suggest that you would make an additional $11,000 per year when you take into account the 5 different ways we make money in real estate. So you're going to get another $11,000 in total return. If you held it into year 3, you would get about another $11,000 in total return. If you held it into year 4, you would get this, an additional $11,000 in total return. What if you held it into year 5? Yeah, broken record time. An additional $11,000 in total return. So you know for a fact, well, it's not factual. I mean, these are all projections. Let's put it that way. You know, based off of a projection, that for each year you continue to hold the asset, you can make it another $11,000. So you're effectively taking that $11,000 that you put into the deal, and you're doubling it for every year that you hold. Year 2, you get an extra $11,000. Year 3, you get an extra $11,000. Year 4, year 5, extra $11,000 in each year. And you're wondering, you're like, well, wait a minute. In year 1, we got like a total of like $31,000. Why does it drop off to like only an extra $11,000 per year thereafter? It's because we captured the equity in year 1. So we applied that equity capture in year 1, and we used some of it to pay the costs of sale. That's how we returned about $31,700 in returns, or a total return of about $42,700 in year 1. But because we've already calculated equity capture, and it's a one-time thing, you capture equity when you lock in all of your deal points when you're buying the property. It's a one and done. You once you obtain it, You've obtained it. You don't get to keep obtaining it. The other ways that we make money in real estate, the other four, are perpetual. So those are ongoing. They are contributing each year to your return. So if you held the asset into year 2, you would have turned $11,000 into effectively $53,000. Or you would have had a net total return of around $42,000. That represents a 384% return on investment if you sell the property at the end of year 2. Still pretty good. You went from 288% to 384%. Well, let's say you own it for 3 years. That $11,000 turns into a total of $64,000, representing about $53,000 in net total return, or a 483% return on investment. Year 4, same thing happens, except now you're at like a 586% return on investment. And in year 5, you're at almost 700% return on investment. Let's say you held this thing for the whole 5 years, and you're getting a little nervous because you repaired everything that could have gone wrong in the first 5 years. So now, as you're looking at year 6, you're thinking, wow, things might start breaking. So I might have some additional expenses, which could impact my cash flow. Maybe this is the time to pull the trigger and sell the property. So at the end of 5 years, you pull the trigger and you sell the property. You would have effectively turned $11,000 into a total return, to include that $11,000, of $87,250. Your net total return is $76,250 in addition to the $11,000 you put into the deal. This would be a screaming deal. Now, this is a deal where I would be looking at that year 1 return, and I'd be looking at, okay, how quick can I get my money out? Because remember, we captured a lot of equity. We put $11,000 into the deal, but we captured $45,500 in additional equity. That money sits in equity until we do one of two things. We either sell the property, which is always a viable option, especially after a year and a day. I want to hit that point home. Or we refinance the property and take money out that way. Either way is permissible. Now, if you refinance, it may have an effect on your cash flow. It may reduce your cash flow because you have a higher mortgage that you're applying to the property. Kind of interesting, right? I know you're like going, dude, you're blowing me away. You're blowing me away with the returns. You're blowing me away with the numbers. That's what real estate does. Real estate blows you away. You have no idea of the power of real estate unless you spend a little time studying it, like I do. And then you become a member of Lifestyles Unlimited, like I did. And you start participating. You start coming around. You get the education done. You start hanging out with your fellow like-minded real estate investors. You start tapping into those sources. You start working with your mentors. You start getting information that helps shape all of this in your mind, kind of the way it's shaped in my mind. And I'll be honest with you, it's hard for me to articulate some of this information because I have a tendency to talk above your skill level. I do. It's one of my fatal flaws, and I work real hard on not doing it on this radio show, but sometimes I do it. And here's the thing. I'm not trying to do it. I'm not trying to be rude. I'm not trying to be mean. I'm not trying to leave you in the dust. It's just that when you become educated, you just know stuff that other people don't know. It's just the way it is. So what I try and do is I try and articulate this information to you at whatever level of information you have, with a caveat. I know you're intelligent. I know you can grasp onto concepts pretty easily. So I take you down to a baseline, I add like 3%, and I give you what I give you. And I hope it helps. I hope it really helps. Now, what would I do? If I had bought this property, invested my $11,000 into the deal, what would I do? I would strongly look to sell the asset after a year and a day. Because even though I can make an additional $11,000 per year holding the asset, one of the things that I'm looking at is I've effectively turned $11,000 into $42,000. If I have that $42,000 in my hand, how many more properties can I buy with that $42,000? Now, if I can buy them at $11,000 per asset, like I can buy this asset, that's almost 4 properties. So imagine if I could turn 1 into 4. Might be a bridge too far. It might be a little bit in the hard to do box. But isn't it cool to know that you could sell 1 and potentially buy up to 4? You might have to put a little bit more of your own cash into the deal, but not much more, right? Especially if you can buy them at $11,000. Well, let's say you can't buy them at $11,000. Let's say that in a year the market changes and you can only buy at $22,000. How many could you buy? 2, right? So you will have effectively traded in 1, received money, and then turned around and with that money would have bought 2 deals, 2 assets, 2 investment choices to replace the one you sold. And if the 2 that you bought do anything like the one that you just sold, you're doing things the right way. Now you've got 2 assets producing an income stream. So instead of pulling in $2,500 per year, you're now pulling in $5,000 per year. And so far, it's only cost you $11,000 to do that, and you're well on your way. Imagine the possibilities if you cashed in your 401k and used all that money to buy real estate. Imagine how close you would be to retirement. If you want to do what I'm doing, you want to do what the members of Lifestyles Unlimited are doing, go to lifestylesunlimited.com, click on Start Here, and let's get you going.
Thank you for listening to Lifestyles Unlimited's Real Estate Investor Radio Show. Ready for more of the map? Visit lifestylesunlimited.com. Explore our videos and articles. Click on the radio tab to access past show podcasts. View the radio show schedule and listen to our best of radio shows. Want to continue the conversation? Follow Lifestyles Unlimited on Facebook today. We want to meet you as well. Sign up for a free workshop at lifestylesunlimited.com. Until next time, remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.